One of the questions I get asked all the time is, Jennifer, what happens during evaluation? Well, today I want to pull back the curtain and walk you through exactly what the process looks like. Because here's what I found. At some point in almost every dentist's career, there's a moment when you realize the practice you've spent 20 or 30 years building is about to be evaluated by someone who's never held a handpiece. And you're trusting someone you barely know to determine the value of something you've spent decades building. That feeling of being vulnerable, of not knowing if you're about to be taken advantage of, is exactly what an independent valuation is designed to prevent. Over the last 8 years, I've worked with hundreds of healthcare practice owners on EBITDA-based valuations. And one thing I've learned is this: almost every owner walks into the process with assumptions about what their practice is worth, and many expect their EBITDA to be higher than it ultimately turns out to be after the normalization process. That gap between expectation and reality is the difference between walking into a buyer conversation confident and walking in vulnerable. So rather than talking about valuations in the abstract, let me show you exactly what it's like to work with me. We'll walk through the review session itself, the adjustments that help protect you from being lowballed, and exactly what you'll walk away with at the end of the process. By the time we're done, you'll know exactly what to expect if you decide to have your practice valued, and more importantly, why this one step puts you at a level playing field with buyers who otherwise have every advantage. Most dentists think evaluation is about confirming what they already believe their practice is worth, but it's actually about eliminating every assumption that makes them vulnerable. Most dentists assume evaluation is just a formality, a piece of paper that confirms the number they've had in their head for years. In reality, that's not what a good valuation is designed to do. It's designed to strip away assumptions, so when you sit down with a buyer, you're walking into the conversation with numbers you can confidently support. An independent valuation isn't there to make you feel good about your practice. It's there to help make sure you don't get blindsided by a buyer who's been through dozens or hundreds of acquisitions. In 8 years of performing EBITDA-based valuations, I've never had a practice owner come in with a completely accurate understanding of what their EBITDA actually is. Not once. And it's not because they're bad at business, far from it. They're focused on running a successful practice. They see strong collections, payroll is covered, the bills are getting paid, and naturally they assume everything underneath is healthy. But EBITDA is not revenue. EBITDA represents the earnings a buyer expects to receive after taking the practice over. And that number is almost always lower than what the doctor expects. To get there, we adjust for income and expenses that aren't expected to continue under new ownership. If a practice booked a cash reward from a credit card, for example, that gets normalized out because a new owner probably wouldn't be using that credit card. If they have wooden floors and it costs $30,000 to replace them, that gets added back because it's not an expense somebody expects to pay every year. The entire process is built around one question: what are the actual defensible earnings of the practice, assuming the practice continues operating under normal circumstances? The dangerous part is that most practice owners don't realize they're relying on assumptions until a buyer begins due diligence. Every serious buyer is going to perform their own EBITDA assessment. They'll review your financial statements, make their own normalizing adjustments, and arrive at their own conclusion about what your practice is worth. If their conclusion is significantly different from yours, you can confidently defend your valuation and negotiate for a higher offer. That's why I believe a valuation should always be conservative, defensible, and rooted in actual recurring operations. My goal isn't to tell you the highest number you want to hear, it's to give you a number that will stand up when a buyer performs their own analysis. Because if your numbers don't hold up, you don't just lose negotiating leverage, you could lose the deal. And that's exactly why this process matters. An independent valuation isn't about producing the highest number, it's about giving you confidence that your numbers will stand up when a buyer begins asking questions. When you know your valuation is supported by defensible, well-documented adjustments, you walk into those conversations prepared, not hoping your numbers survive due diligence. That confidence is what puts you on solid ground. But most practice owners never actually see what goes into producing that valuation, and that's where the uncertainty comes from. They imagine the process is more complicated or more intimidating than it really is. So let's take that mystery out of it. Let me show you exactly what happens during evaluation, step by step, so you know what to expect from beginning to end. The evaluation process isn't a black box, it's a structured, collaborative review that takes about 60 minutes and follows the same pattern every time. A lot of dentists assume evaluation is going to be complicated or filled with financial jargon only accountants understand. In reality, it's a structured, repeatable process that looks at your most recent, or often called trailing, 12 months of financials, line by line, and makes normalizing adjustments to account for income and expenses that aren't expected to continue under new ownership. Evaluation doesn't have to be complicated. It's simply a structured process, and once you understand the steps, there's nothing mysterious about it. The first thing I do is gather the most recent 12 months of your financial information. In the financial world, we call this the trailing 12 months. Looking at the most recent 12 months of performance gives us the most current picture possible before making normalization adjustments. For example, if we're meeting in October, I don't want to base your valuation on financial statements that only go through the previous December. I want the most current picture possible. So we start by pulling your profit and loss statements for the last 12 months, and then we schedule a video conference review with you and anyone else you would like to include, whether that's your office manager, your bookkeeper, your CPA. That typically happens over video and lasts about an hour. And I promise it's much more conversational than people expect. We're simply talking through your business together. We'll walk through every revenue and expense line item and identify anything that's non-recurring or unusual or personal. Practices with multiple locations may take a little longer, but once you've been through the process, you'll have a much better understanding of what I'm looking for and why. The reason the review is collaborative is because I need to understand the story behind the numbers. If I notice an unusual expense in March, for example, I need to know whether that was a one-time equipment purchase or something that's likely to happen again next year. There are almost always a few items that require a little more research after our meeting, and I jokingly call that your homework. Rather than trying to figure everything out during our call, I'll make a list of those items and send it to you afterward. Sometimes it's as simple as asking you to look up detail behind an expense in QuickBooks. Maybe I notice an unusually large office supply expense, and after looking into it, you realize that part of your Costco purchase was actually for your personal residence. Or perhaps we need to determine whether a repair expense was truly a one-time event or if it's something likely to recur. The goal isn't to make assumptions, it's to make sure every adjustment is supported by facts. Most of the time, the homework is pretty straightforward. It's simply answering a few follow-up questions so we can make sure your evaluation is as accurate and defensible as possible. Regarding compensation, if you've been paying yourself less than the fair market replacement compensation for someone with your level of experience and skill, that means your EBITDA is inflated. A new owner would need to pay you or a replacement doctor fair market compensation to perform the work you currently do. Perhaps you own the real estate and you're not charging yourself rent. This means EBITDA needs to be adjusted down to reflect fair market rent for the space. The whole point of the review is to surface every assumption before a buyer does. So now you have a better understanding of what the process looks like from the outside. But the real work happens inside those individual line items because even a single adjustment can have a meaningful impact on your EBITDA. If those adjustments aren't identified before you go to market, they're likely to come up during a buyer's due diligence. Most practice owners assume that if they collected the money, it counts, and most of the time that's true for running the business. But evaluation asks a different question. Will that revenue be there after the practice changes hands? On the expense side, we also remove personal expenses and one-time costs so the buyer sees what it would actually cost to operate the practice going forward. Throughout the valuation, I'm asking the same question over and over. Would this dollar still be here if someone else owned the practice? On the revenue side, there are usually fewer normalizing adjustments simply because there are fewer types of revenue than there are expense categories. But we still need to identify any income that isn't expected to continue after the sale. For example, maybe the practice received a one-time legal settlement or insurance payment that isn't part of the ongoing operation of the business, so it wouldn't be appropriate to include it when estimating future earnings. The goal is simple. We want the buyer to see recurring revenue, not one-time events that won't happen again. The expense side is where we usually spend more time because that's where most of the normalizing adjustments occur. We're looking for expenses that won't transfer to the next owner. That could include personal expenses, family members on payroll whose roles won't continue after the sale, club memberships, personal cell phones, or other discretionary expenses that really aren't part of operating the practice. I've seen owners accidentally or sometimes intentionally run personal household expenses through the business. My role isn't to judge those decisions. My role is simply to identify them, determine whether they should be normalized, and arrive at an EBITDA that accurately reflects how the practice actually performs. These adjustments matter because they reveal the true earning power of your practice. Before a buyer performs a detailed review, they may estimate your EBITDA using financial statements alone, but once due diligence begins, they're more likely to take a deeper look and do their own normalizing. If you've already gone through that process with an independent valuation, there are far fewer surprises. Instead of relying on the buyer to tell you what your practice is worth, you'll already understand your normalized EBITDA and be prepared to support it. The goal of an independent valuation isn't to create the highest EBITDA possible, it's to arrive at the same defensible EBITDA that a sophisticated buyer is likely to calculate. That means fewer surprises, fewer negotiations, and a much smoother transaction. Here's one of the biggest misconceptions I hear. Practice owners assume every expense on their profit and loss statement reduces the value of their practice, but that's not necessarily true. Just because an expense happened doesn't mean it should reduce the value of your practice. Let's look at a few examples. Imagine you had to replace your computer system, repair damaged flooring, or make a one-time improvement to the office. Those are all real expenses, but they're not expenses a buyer expects to incur every year. Because they're non-recurring, they may be added back to EBITDA, meaning they don't permanently reduce the earnings of the practice. A simple rule of thumb is this: if it's not part of your normal annual operations, we take a closer look to determine whether it should be normalized. The goal is to show the buyer what it actually costs to operate the practice year after year, not what happened during one unusual year. Revenue can be normalized too. Let's say an associate took maternity leave or had a medical issue that kept them from seeing patients for several months. During that time, the practice naturally produces less revenue. If we know that reduction is temporary, we can normalize for it by estimating what the production would have looked like under normal operating conditions. Again, the goal isn't to inflate the numbers, it's to present a realistic picture of what the practice would have earned if that temporary disruption had not occurred. Hopefully, you're beginning to see a pattern. Every normalizing adjustment has the same objective: remove anything that's unusual so the financials reflect how the practice normally performs, whether it's revenue or expenses, or trying to create a level playing field so the buyer sees the true earning power of the business, not one unusually good year or one unusually difficult year. Of all the normalizing adjustments we review, two consistently have a very big impact on EBITDA: doctor compensation and rent expense. They're also two of the adjustments that surprise practice owners the most because they seem perfectly reasonable from an owner's perspective, but buyers look at them very differently. Let's start with compensation. If you're paying yourself less than it would cost to hire another dentist with your experience and skill set, EBITDA has to be adjusted downward. Why? Because a buyer can't assume they'll find somebody willing to do your job for what you're paying yourself, which is less than market compensation. The same idea applies to rent. If you own the building and you aren't charging your practice a fair market rent, or not charging rent at all, it may feel like extra cash flow to you because you're paying yourself either way. But from the buyer's perspective, the practice has to occupy that space somehow. Whether they lease it from you or from someone else, there's going to be rental expense on the P&L. That's why we normalize the financials to reflect what a typical tenant would pay for in that market. Owning your building doesn't automatically increase your EBITDA. One of the reports I review closely is collections by provider by month because it helps me evaluate owner compensation. One of the biggest adjustments we often make is to reflect a fair market replacement salary for the dentist you, as the owner, are actually providing. In most cases, that's based on the collections you personally generate for the business. If you're paying yourself less than what it would cost to replace you, EBITDA has to be adjusted downward because a new owner would need to pay a replacement doctor appropriately. On the other hand, if you're paying yourself more than fair market compensation, EBITDA is adjusted upward because the replacement doctor would likely cost less. The same principle applies to real estate. If you're leasing your office, I want to understand the terms of that lease when it's up for renewal and if the same rate will apply or if it's being increased, and by how much. If you own the building, I need to determine whether you're charging the practice fair market rent. Even though you own both the practice and the real estate today, a buyer has to look at the practice as if it were operating independently. That means the practice needs to pay a market rate for the space it occupies. I've had doctors push back on this adjustment because they assume owning the building increases the value of the practice. And it does, but it increases the value of the real estate itself, not the operating business. After the sale, you'll still own the building and you'll expect the new owner to pay rent. So that becomes a legitimate operating expense of the practice. These two adjustments matter because they're often the largest adjustments we make during evaluation, and they're also the ones that surprise practice owners the most. Once compensation and rent are normalized, EBITDA can change significantly. In some cases, I've seen those adjustments reduce value by hundreds of thousands of dollars. That's exactly why I encourage owners to understand these issues before they ever go to market. Sometimes there are opportunities to make changes ahead of a sale. Other times, the benefit is simply knowing your true value before you're sitting across the table from a buyer. The goal is not to maximize EBITDA at any cost. The goal is to produce an EBITDA that both you and the buyer can agree on. By the end of the process, you'll walk away with something much more valuable than a number. You'll understand exactly how that number was developed, why each adjustment was made, and you'll have a valuation report that documents every assumption along the way. More importantly, you'll walk into conversations with buyers knowing you can explain and defend your EBITDA with confidence. Nothing in the report should come as a surprise to you because we've already talked through every single adjustment together. Evaluation isn't just a number, it's the confidence of knowing you can support that number when a buyer starts asking questions. Once you provide me with follow-up items that I've requested during our video review, I'll prepare a draft valuation report, send it to you to look it over, and if you like, we can schedule another meeting to walk through the numbers together. That second meeting isn't required, but many clients appreciate the opportunity to ask questions and make sure they understand and are comfortable with each adjustment before the report is finalized. The report includes your normalized EBITDA along with a detailed explanation of every material adjustment that was made and the reasoning behind it. Whenever assumptions are necessary, they're clearly documented so everyone understands how they were applied. Whenever possible, I avoid speculation and instead rely on the most supportable information available. The reason the documentation matters is that buyers are going to question every number. If you can't defend an adjustment, the buyer will undo it. That's exactly why every meaningful adjustment is documented in the report. The goal isn't simply to produce a valuation, it's to produce one that both you and the buyer can understand and agree with. Speculation is not anything a buyer wants to see in a valuation, so if we don't have better information, we assume status quo. But of course, whether or not that aligns with the new owner will have an impact on EBITDA up or down. Once you sign off on the pro forma, your final deliverable is a comprehensive valuation report documenting every meaningful adjustment, and that concludes the valuation process. So here's what to do with all of this. If you're thinking about selling now or in the next 12 to 24 months or beyond, I encourage you to have an independent valuation done before you have a single conversation with a buyer. Because once your adjusted normalized EBITDA is finalized, it gives you an incredible advantage. Knowing what you're worth in the eyes of a buyer, when you sit down with a suitor in the marketplace, you are no longer vulnerable and you will not be relying on the buyer to tell you what your practice is worth. Assuming I receive the information I need promptly and we're able to answer any follow-up questions quickly, the entire process can often be completed in about a week. That 1 week of work can give you the confidence of knowing exactly where you stand before you ever begin negotiating with a buyer. It's one of the best investments you can make before taking your practice to market. It's quick, painless, and very affordable. I've seen firsthand how stressful selling a practice can be. My goal is to remove as much uncertainty from that process when possible. When you understand your numbers before a buyer starts asking questions, you walk into those conversations with confidence instead of anxiety. If you found this helpful, be sure to subscribe because I'll be releasing another video soon covering the most common mistakes dentists make before selling and how to avoid them before a buyer finds them. I'm Jennifer Arsenault with Executive Valuations. I hope you enjoyed watching.